Hey everyone, it's Helen from SMB Deal Hunter. Today we have Brian Wolfe with us, a lawyer, small business investor, and private equity and search fund professor. Brian founded Funded Ventures, which partners with builders to buy and build small businesses. And their first platform, which was formed to acquire SaaS companies in the MarTech space, successfully exited to Alpine Investors. So congratulations, Brian. Very much so looking forward to hearing Brian's story. Brian, it's great to have you on today.
It's great to be here. Thanks very much for having me.
So, Brian, you were a partner at Kirkland, probably working on massive transactions. What got you into the small business space? Tell us more about your background.
Yeah, so before I went to law school, I worked at Amazon for a couple of years. This is back like 2002 to 2004. So Amazon was a lot smaller than it is today. And I knew I was going to go to law school. My dad was an ERISA attorney for 40 years at the same law firm, and I knew that wasn't going to be me. And so I ended up going to law school, and I came out and I joined a large law firm, as you mentioned, doing private equity M&A for large private equity firms. And I really enjoyed that experience. I really enjoyed working with very smart people on sophisticated deals. And a couple of things happened. I was doing a lot of deals for private equity firms that do roll-ups, right? They go into a highly fragmented space. They'll buy a bunch of the competitors and they'll put them together and they'll grow the platform organically and sell it. And oftentimes when you do that, you experience multiple expansion. The price that you ultimately sell the platform for on a multiple basis is larger than the valuation multiple of the component parts. And I always say that multiple expansion is like the eighth wonder of the world. So I was seeing that up close as a deal lawyer, and I was also investing in a lot of private equity funds for sponsors who did these roll-ups. And I thought, man, this is really, really interesting. There's something really unique and special. And it was pretty fortuitous. There are some folks in our community outside of Chicago where I live who teach the ETA search fund class at the University of Chicago, or they transact in the lower middle market at private equity firms. And I started talking to them, and they said, listen, there's a real opportunity for you to sort of take what you've learned as a deal lawyer, but now transition to the principal side and go out and do some deals. And so that's what I did. I ended up partnering with someone from our community who had a CS background, who had bootstrapped a small SaaS company that he sold to a portfolio company of a private equity firm. And he had spent a couple of years working for that private equity firm and was finishing his commit. And he said, hey, do you have any interest in going out and partnering together and doing something? And so we ultimately decided to partner on doing a roll-up at sort of the micro cap end of the market in the software space. We had a very specific thesis. And basically that thesis was, when you read headlines about software, you always read about these SaaS companies trading at 5 times revenue, 6 times revenue, 7 times revenue, these really frothy valuations. But the dirty little secret is that if you're a low growth SaaS company, if you're only growing at 3 or 4 or 5% a year organically, you're not worth much. You're not worth 5 or 6 or 7 times ARR. You're only worth 1 to 2 times revenue. And so, our playbook was that we would go out and find technical founders who had bootstrapped their small software companies. We focused on the MarTech space, companies that productize organic search results. And we would buy those businesses and we would put them together, and hopefully we would grow that platform organically and we would sell it. The one point that I'll make is, some of your listeners will have heard of the so-called Rule of 40. And basically what the Rule of 40 says is, when it comes to SaaS companies, valuation comes down to 2 things. One is organic growth, and the second is margins. And so our playbook was, could we find these low growth software businesses that were only growing at 3 or 4 or 5% a year? Could we put them together? Could we grow that platform? Could we underwrite sales and marketing and get the overall platform growing at 25, 30% a year? And our thesis was that if we could, based upon the Rule of 40, we'd be able to sell that platform at more of a normalized valuation, somewhere around 5 or 6 times revenue. So we did that. We did it for about 20 months. after our third deal, we got a little bit lucky. Alpine Investors, which is a large private equity firm, had caught one of our press releases, reached out to us, and ended up buying our platform. We stuck around for about a year. We had an earnout that came due. We got that wrapped up. And on the other side of that, I re-engaged at my law firm. I had taught a class on private equity at Washington University in St. Louis. I started teaching their business school class on ETA and search funds. I'll also teach that class at the University of North Carolina this spring as well. So today, I've really sort of throttled back my law practice. I spend a lot of my time teaching, and I've also started a small firm, as you mentioned, Funded Ventures, where I've hired a couple of my former students, and they're out in the market today doing their own self-funded searches, and I'm having a lot of fun just working with them to find acquisitions and hopefully close on them. And then the fun begins. We'll start to work to grow those businesses.
Wow, fantastic background. I have so many questions. I guess first, with the first platform that you guys, the first role you guys started and exited in such a, fast period of time, how are you guys able to transact so quickly?
Yeah.
3 deals in 20 months is no joke. So,
Yeah. It was really a combination of all the things that you would expect. We found our first deal in a broker-led process. We were relatively flexible on various areas of SaaS. So this just happened to be the first deal that sort of, met our sweet spot. We closed on that deal. We ended up in the second deal, we started to, one of the products that we had was a white label solution. And so we started having a bunch of conversations with all of our competitors. The second deal actually we acquired one of our competitors. And then in the third deal, the owner of that business actually also saw one of our press releases and reached out to us and said, "Hey, any chance you're in the market for more deals in this space? If so, I'd love to have a conversation." So it really was sort of a mixed bag of, going out and trying to cause those conversations to occur, as well as, trying to be public about what we were doing and sort of see what would come back from folks in the industry.
yeah, I always tell people, the first one is the hardest, but
Yeah.
the second, third, etc. It seems like you definitely saw the same thing.
Well, and it's also not picking one strategy, right? It's not A or B or C. Do it all, right? I mean, really, if you're going to go out there, as the marketplace is competitive. And so I always tell my searchers, we should be, doing proprietary outreach. We should be talking to every broker we can find and looking at all of the companies for sale on their websites. We should never be thinking about this as either or. It should be, let's do A plus B plus C.
No, makes total sense. The first partner that I guess was it you backed, I guess? How did you guys, what made you feel confident in his potential and um
Yeah.
what
Well, it
made you
helped
believe in
that he
him?
had bootstrapped a small SaaS company already. He studied CS at a good undergraduate school. I knew him personally. He was in my community. And so, some of it was just serendipity. It was sort of a fundless sponsor situation, although I was very, very involved day to day too. I mean, one of the things that I really enjoyed about that situation, basically what our core product was it was a product that allowed you, if you were an e-commerce marketing manager, to see how your company was doing across a bunch of different search terms. So imagine a new pair of Air Jordans drops. If you're Foot Locker and a kid types in new Air Jordans, if you show up in the first slot or the second slot or the third slot on Google, where you're at has a significant correlation to whether or not that consumer is going to buy from you. So the neat thing about that is every e-commerce manager, marketing manager in America needs that product. They need it through their agency. They need it directly from a company like ours. So it was a lot of fun for me to just constantly pick up the phone, constantly send emails out to everyone I knew and to sort of say like, listen, you're probably already using, your company's probably using a product like this one. I would really appreciate it if you would allow us to sort of walk you through the product that we have. We think we're really good at this. And that's a lot of fun. When you have the opportunity, when you've got a massive market size that you can sell into, it makes it a lot more fun to go out there from a commercial execution perspective.
No, it's super interesting, and I definitely can agree. I ran an e-commerce store, and we definitely used a tool like that. So,
Yeah. Yeah.
no, that's super interesting. And did you guys integrate all these companies in the 20 months? You ran them separately? What was that like?
Yeah, there was some integration. We had like a master plan for how everything was going to get integrated and how we were thinking about brands. We ended up selling the platform before a lot of that was realized. So, basically what we ended up doing, one of the businesses that we bought was a little bit more focused on sort of the agency space and our white label solution. One of the businesses that we bought was more of a product that you would use, on more of a direct basis. So for the most part, we sort of continue to operate the brands. We try to create efficiency with our back end stack. So at least operationally, we could create some synergies and some efficiencies across the platform. But we never got to a place where everything was totally harmonious. The buyer of our business did that, ended up buying our business, some other MarTech businesses as well, put a lot of thought into exactly how to create a dashboard with these different modules and how the brands all fit together. That's hopefully where we would have gone, but we ended up exiting before we got there.
Got it. And during that, the 20 months that you guys were operating these businesses, were you able to grow them? Were you mostly focused on M&A? What did that look like?
Yeah, we grew them a lot. I mean, we really got lucky on that front too. Some of these bootstrapped, it's really interesting, right? Like these bootstrap software companies, I should mention this, they're often only growing at 3 or 4 or 5%, not because they're not great businesses. Oftentimes the technical founder makes a decision. Something happens in their life. They get married. They want to buy a house. They start a family. And instead of taking the rich cash flow that they're generating and reinvesting in their business to actually grow the business organically, they start to run it like an annuity. And they take the cash flow out of the business and put it in their pocket to do all the things that you and I need to do, put food on the table. Once they make that decision, and their business starts to stall from a growth perspective, the valuation of their business plummets. Now, at the time, they're not cerebral about that. They're just trying to take care of their needs at home. And so for our part, when we would come in and buy these businesses, we would be able to come in there and really invest some capital to grow these businesses from a sales and marketing perspective. We were able to stand up a sales team. We were able to do some marketing and some advertising. So those are a couple of the things that allowed us to start to really get that flywheel growing from an organic growth perspective. The other thing, though, is, I had a friend in the Midwest who just, because I spent a lot of time talking to people in my network, I learned owned one of these agencies, which spent hundreds of thousands of dollars on the product that we were selling. And we ended up being able to sign a multi-year contract with her, which was a total game changer in terms of our organic growth. And so we got lucky. But, we had to do the hard work to sort of get lucky on that.
Oh, I mean, that's fantastic. And I guess during these 20 months, the deals that you guys did do, how did you structure and finance them?
Yeah. So we did start with a 7A loan. One of the things that I was really focused on is, as an M&A attorney, I'm comfortable with complexity, right? I'm comfortable with, whatever it takes to sort of get that deal done. I'm comfortable with how we're going to structure it and how we're going to memorialize it. What we ended up doing for the third deal, as an example, is a tremendous amount of the purchase price was all in a seller note. It was, primarily seller financed. And obviously, there's all sorts of conversations that arise when you do that around credit support and guarantees. But we were very, very equity capital efficient, both tapping the SBA 7A loan program as well as negotiating for a lot of earnouts, a lot of seller paper, a lot of things that allowed us to sort of limit the amount of equity capital that we put into this platform.
And how did you structure terms with the sponsor you backed? How did you incentivize him?
Yeah, I mean, this was one of the other benefits to having somebody in my community is that there was a high level of trust. I think that there was a high level from a shared commitment perspective around what we were doing. So we documented our arrangement, but honestly, it was probably less paper than, what I would do on an arm's length basis with somebody I didn't know or someone I didn't have a relationship with. So, we did have our arrangement memorialized there. There was a negotiation, but to be honest, we really tried to not get too focused on, the minutia. We try to focus on what we were trying to achieve from an outcome perspective and arrive at a place where we felt like we were both valued.
Got it. So you were so basically your role was mostly the investor. Obviously, you played an active part. And were you expecting, your partner to also put in money in the deal, or was he more so like the sweat equity?
Yeah, he did put money in. Excuse me. Um, I spent a lot of time both on the sales and the commercial execution front, as well as on the M&A front. Because of his CS background, he spent a lot more time focused on the product roadmap and really just, for these small businesses in the IT space, things break all the time. And so I don't have a fluency with that. And so, to his credit, he was the one who woke up at 2 a.m. when something broke and had to figure out how to get, the data out to the customers the next morning. He definitely worked more than I did on a day-to-day basis. He was showing up at our office, more than I was. But I think we both agree that we wouldn't have got to the ultimate outcome without, both of us sort of contributing in the way that we did.
No, and it sounds like you guys have very complementary skill sets, so that's great.
Yeah.
I'm curious, when Alpine Investors approached you guys, you mentioned I think they saw a press release. So I
Yeah.
guess that's a commentary to everyone. Make sure you you do a press release
Yeah.
with each acquisition. But what did that look like in terms of like
Yeah.
first conversation to actually getting the deal done?
Yeah.
What was that timeline like? What was that process like?
It's very short. Um, Alpine, to their credit, they had just stood up what's called Alpine Software Group, ASG, which is sort of their software affiliate, and they had decided that they were going to grow it, and so they came out pretty strong, and they ended up standing up something like 3 platforms. They may have done 10 deals in like 6 weeks. I don't remember what the volume was. It was incredibly frenetic. So we were just 3 deals. Our 3 companies were just 3 amongst, I don't know, 10 or 12 that they were working on for this affiliate, sort of all at the same time at the end of a calendar year. And so consequently, they sent us, I think we started with just a conversation. They had decided that one of the platforms that they were going to build would be in this MarTech space. So they had already sort of had the sorts of products that we were selling on their roadmap. Uh, to their credit, they made us, what we thought was a fair offer, sent us a term sheet, sort of middle of the road on all the things that you would expect. That's one of the benefits, of course, whenever you transact with a more sophisticated institutional investor, is this is what they do for a living, trying to get every nickel and dime or try to, be heavy-handed just to assert their relative position. That's just not their game. And so this moved very quickly. They sent us an LOI. I think maybe we had, a couple of comments, but for the most part, we signed the LOI and sort of gave them this exclusivity period. They ran a Q of E with a top shelf account. They were very gracious. They actually shared that with us, which was great. We could learn a lot about our business at a level that we probably weren't operating it at through that Q of E. And then we closed. It took, I don't even recall. It's been a little while. It took certainly a couple of months. But it felt like it was moving pretty quickly. They wanted to buy this platform, and we were, excited, to have them sort of be the ones to take this forward in the next chapter.
No, it's interesting. What were some of the things they dug into during diligence? Obviously, they did a QV, but
Yeah.
what else did they really focus on?
Yeah, I mean, a lot of it really was, they were very focused on all of the metrics that you would expect in the software space. Metrics like, our acquisition cost and, a lot of the diligence that they were doing, it was sort of working through on their side how our products fit within this broader platform that they wanted to build. And so a lot of that diligence, it was asking us a bunch of questions. We didn't really have context to try to think through and architect and confirm that our products would sort of fit well within what they were doing. So it was a little bit opaque to us. I mean, we had a very small team. We only had probably 4 or 5 folks on our team. A lot of the technology was all powered sort of through AWS, so it was off-prem and all this stuff. What they were really interested in, I think, is just making sure that there's no fraud, that these customers are real, that there's no expectation that that revenue is going to go away. But beyond that, I think it was starting to think through how they were going to sort of architect this broader solution that they had in mind.
That's interesting. And how was the earnout structured? And what were they
Yeah,
sort of expecting you guys to like? How involved were you guys, post
yeah, we
acquisition?
were we were very involved. It was based upon ARR, annual recurring revenue, subscription revenue, and we worked really hard because within it was a 12-month earnout, and you just tested it once. You looked at the 12-month anniversary date of the closing, and you compared ARR then to ARR at the closing. My recollection is that you needed to see some revenue growth. I recall that it wasn't a huge jump in what we needed to achieve, but there was some growth. And some of these businesses, after you acquire them, particularly if you're doing a lot with the product, you may actually see a little bit of deterioration. Now private equity owns this business. Things start to, just function from a process perspective a little bit differently. And so the businesses that we sold, I think there was, at least one larger customer that the business had lost. And so my partner and I were really focused on getting the earnout. And so we worked really, really, really hard. And to Alpine's credit, they would make themselves available to us, not only from a time perspective, they also invested in some of the things that we thought that they should be doing to really grow that business so that we could reach the earnout. And we did, but it was in like the final month. And it
Wow.
was, it was really like we dialed a lot of numbers to get it done. I think sometimes in earnout, it's not nearly sort of that hands-on. But really to their credit, they allowed us to have the opportunity to really sort of fully get that done.
And you've seen a lot of these transactions to private equity. What are sort of common earnout terms you generally see?
Yeah.
Is most of the cash given to the seller, you guys up front? Is it, is a lot of it still held back? What's kind of common there, especially I guess in SaaS or in other industries?
Yeah. I mean, in like upmarket private equity, there are definitely earnouts. I'll focus this on sort of the subscale end of the market. The size of the earnout, I mean, imagine this is more like 10 or 12% of the aggregate, purchase price, right? So it's not nothing. It's also not like 50%. I mean, there certainly are situations where almost akin to like seller financing, a large amount of the purchase price will be in sort of the earnout. That's not the path we went down. We wanted a lot more certainty in terms of what we were selling our business for. I think we just had a gap in terms of what we wanted to receive for our business and what they were willing to pay. And we just all sort of agreed let's just put it into an earnout and let's do it around something that should be easy to define, like revenue. And let's just keep it reasonable and just look 12 months down the road. What I'll tell you though is, earnouts, and I see this all the time in private equity land, the percentage of earnouts that get disputed or eventually get litigated, it's really, really, really high. Because
Really?
often really high. Like I want to say I've seen statistics where it's like north of 20%. And the reason for that is sort of obvious when you think about the deal dynamic that causes the earnout to even arise. Usually what happens is a situation like ours, which is like we're basically agreed on everything. There's just this gap on purchase price. We're pretty late in the term sheet negotiation stage. Man, we'd all really like to get this done. And then somebody's like, let's just throw it in an earnout. So there's no desire at that stage to slow everything down and have the lawyers come in and do this exhaustive negotiation defining, the target metric, or defining the time period, or what people's covenants are from how hard they're going to work to achieve it. None of that stuff happens. Like, it's just not practical usually. And so consequently, what does that mean? That means everything is often sort of shorthanded with respect to the terms around the earnout. And that's why, you'll read some of these earnouts and you're not surprised at all that people were not thinking about things the same way, or they just never engaged on the minutia of how these earnouts would get calculated, because they were just so excited that this was the solution that would allow the deal to move forward.
No, that's surprising to me, but also not surprising
Yeah.
after you explained it. And since you guys sold the business or the businesses, what have you been sort of working on, and how are you spending your time now? You mentioned teaching, you're
Yeah.
now backing other folks.
Yeah.
How are you spending your time?
Yeah. So I'm a big fan of like moving slow and then moving fast. I probably, if you ask my wife, she would say, well, you're really good at the moving slow part. So I ended up sort of re-engaging at my law firm. COVID hit, and that sort of slowed down a little bit, just in terms of my desire to really pursue investing and building businesses sort of full time. And so I've spent several years having hundreds of conversations with people who are in sort of the search fund ETA space, who are in the private equity space, the fundless sponsor space, trying to sort of figure out. I mean, when I step back, I look at the world and I think that when you think about private equity or search funds or ETA, it's three component parts, right? It's asset, it's operator, it's capital. It's those three. Now, like the size of each of those three, how you construct each of those three, are you the operator? Are you the capital? There's a bunch of different permutations for how those formulas can look, but it's really just those three components. So I've spent a lot of time trying to figure out, how do I want to, where do I want to play within those three components? After we sold the business, for a while, I was like, man, maybe I should go to coding school. Maybe I should be the operator and learn how to, gain a fluency around the thing, the product, because someone has to have a fluency around the thing. Luckily, I didn't do that. Then I continued to do, I passively invest in private equity. So I sort of continued to do that, just sort of in a rinse and repeat manner. And then I was asked to start teaching this class at WashU on ETA and on search funds. And that gave me an opportunity to really start to develop a relationship with some younger people around this space that they were passionate about and I was passionate about. And so what ultimately happened was I joined the board of one of the main ETA accelerators, just spent a lot of time having conversations. But one of my students came to me after he took my class and he said, listen, I like worked for a small business before I went to business school. I'm from a small town. A lot of my classmates are going to McKinsey or Bain or, whatever, going into consulting or banking. I don't really have a heart for that. Like, I have a heart for like taking a long view and building a small business in my community. And I wanted to give him a hug. I was like, you are my kind of guy. And so we ended up agreeing to partner on a search. And it's not just about capital. It's not even really about capital. That may be the smallest component. It's really about I spent a tremendous amount of time with him, and he's been at this for a year. And I now have a second student who is working with me too. And then I've got somebody in Cleveland as well. And I spend a tremendous amount of time with these folks, like leading them through the process that we had gone through when we did our roll up. How do you develop great relationships with intermediaries and sell side brokers and bankers? How do you, do a bunch of work to make sure that you're bankable? How do we constantly talk about our best investment ideas and proprietary outreach. And, for a while we loved medical spas and now we don't like medical spas. And then we liked HVAC and now, and just like we always say, we're trying to get to a level of truth. We're trying to get to a place where, we find an asset in an industry that we really, really love. And the playbook is going to be, we're going to close on that deal. And, my partners are going to, each get in the seat of the businesses that they buy. And that's really the starting line. And then they're going to learn how to become operationally excellent at running those businesses. And what I'm hoping is going to happen is we're looking at really highly fragmented spaces that are capital light. I'll be able to then spend 6 to 9 months sort of working to recreate our deal funnel around whatever business they ended up buying. And, again, like the SaaS roll-up that we did, I think doing M&A is going to be a core part of our playbook in those partnerships. And where it goes from there, I don't know. I mean, I'm really excited. I'm doing this all just with them. We will use some debt. I'll invest some equity capital. We're not using third-party equity, but you can imagine a world where we decide to do some bolt-ons, and now we decide to pull in some third-party capital, or maybe we use some mezz debt, or there's a lot of levers out there. But what we've tried to do is create a situation where there's really no conditionality. It's us, and we can write the check, and we can find the deal. And as long as we can close on it, we can warehouse that deal, start to grow that company, and then all that other stuff, all those other levers, sort of, create optionality for us. And then we can figure out how to sort of optimize it. And again, unlike in traditional search, where you raise a search fund and you've got 10 investors and you do this for 5 to 7 years, we want to do what we're doing for like 10 years or 15 years. And, we want to do what we're doing and, not just be invested 10% each. We're all really, really committed to what we're doing. And what this all looks like 5 or 10 years from now, I have no idea. Do I raise a fund? Do I have other searchers? Do I change sort of what our searchers look like? Are they later career? I don't know. But I like everything that we've learned. And I feel like even if we fail, I feel like it's been a great year just to, create all of the building blocks that will get us back to that concept of asset operator capital.
That's no, that's very exciting. I'm curious, what are you looking for in these students that you're partnering up with? What do you think now that you've worked with a couple different people, what do you think
Yeah.
makes someone an exceptional searcher?
Yeah. Yeah, I mean, like the one thing that you have to have that you just can't learn is just like highly ethical and just a bias to keep moving. I mean, searching is so lonely sometimes. It's one of the reasons why for Drake and Max and I, why we love doing it together, because it can be very lonely and having somebody to bounce ideas off of. Inevitably around the holidays, your deal flow, what you have in your funnel, it's not very active. And like that, and it's the turn of the year and you're feeling like, man, like, is this ever going to come back? And so to have somebody hug you and say like, no, it's going to be okay. I've done this before. There's always a bit of a lull around the holidays, I think can be really, really valuable. And so, I mean, the first thing that I look for is like, I really have to like the person. I really have to feel like they are a good person. They have a good heart. That always comes out when we talk to sellers. Sellers, that is a very sort of human reaction, whether that seller and whether that buyer sort of connect. So I always look for that. I look for folks who have good judgment. I look for folks who have a bias toward action. Like my goal is to provide leverage into their searches, but they've got to be able to do like 80% of it on their own. So you got to find folks who are self-starters, who aren't afraid. I mean, it's scary to pick up the phone and start cold calling and hear no all the time, or to make mistakes, and we all make mistakes, and be able to jump back up from those and learn from those. So that's really, really important to me as well. So, I guess what I would say is it's wonderful to find somebody who has that 10 years of work experience. They've had some P&L responsibility. I think it's important that you find people who have some work experience. They've seen that before, whatever that is, particularly from an operational perspective. But I think even more so, character matters. And you have to find people who have good hearts, who are honest people, who have values that are aligned with you, getting back to begin with the end in mind, a common mission. We're all trying to get to the same place together. We're not trying to nickel and dime each other or, pick each other's pockets. If you can get good alignment on that, everything else can get learned.
Oh, wow. That's 100% agreed there. And are there certain industries that you're particularly
Yes.
excited about? You spoke about fragmented spaces, capital light, but what's getting you excited these days?
Yeah, so I'll give you an example of one that I love, although you'll laugh because everyone loves it, but I love it for different reasons. So, one of the businesses we love, like everyone else, is HVAC. Not like we've looked at a bunch of HVAC businesses, not boilers, not technically complex, a lot of piping. This is more forced air units, cleaning them, maintaining them, installing them, maybe some hot water heaters for two reasons. One, post-COVID, particularly from a return to work perspective, but it's true at home, cold, clean air is really an imperative, uh, you know, coming out of COVID. Second, I had read a statistic. It was very sad. Last year in Seattle, like 90 elderly people died in August during a heat wave. Only 50% of Seattle have air conditioning units. And so if you believe that our world is changing, the idea of like coveting cold air, I think is only going to grow. I also heard in New York City, if you own a condo unit and you rent it out, the local statutes require you to provide heat. They don't require you to provide air conditioning. But there's been a lot of conversations at the grassroots level around whether those statutes should get amended to also include air conditioning. All of these things, when you pair them together, I think that cold, clean air is a secular trend. It's a secular tailwind that's going to be here, at least for the next 20 years. There are other businesses that we've looked at. We looked really hard at medical spa. We were under LOI. We decided it's not the right place for us. It's become a relatively crowded space. But businesses that have a higher regulatory overlay, more compliance, I think we found that they can be pretty hard, to buy and operate. It's one thing if you buy one of those businesses as a fundless sponsor and you've got a dermatologist or a plastic surgeon who's actually running them day to day. That's important not only from a compliance perspective, but that's how you actually grow that business from a customer perspective. We're not dermatologists, we're not plastic surgeons. And so we spent a lot of time trying to transact in that space. And we've decided not to. The last one that I really like is legal services. So I'm a lawyer. I've been a lawyer at a large law firm for 17 years. So we're focusing a lot on litigation support businesses. So think stenography, court reporting, expert witness services. There's a bunch of services that law firms use on an outsourced basis when they take a case through the litigation process. I like that space a lot because when I talk to sellers, they get us. They get me. One of my partners also went to law school, has a JD as well as his MBA. They get him too. And so I think that small businesses, it's hard to operate and grow a business. Why make it any more difficult for yourself? Why try to grow your medical spa by competing with the dermatologist down the street from a customer acquisition perspective. I'd rather sell to law firms. I understand law firms. I understand those products and those services a little bit better. So we really, really like that space as well. Highly, highly fragmented, very capital light. There's a lot to like about it. The only issue is it's getting disrupted pretty quickly from a technology perspective. And so we're trying to sort of figure out, what we would do if we got our hands on an asset in that space and look to grow it.
No, I was going to ask you, with AI, how you're thinking about that with the legal services, but it sounds like it's something you are thinking about.
It's funny, although I'll tell you, like, I think that's something that you can arbitrage a bit too. Like I'm convinced, I mean, Warren Buffett always talks about this with gasoline and oil. I mean, you read the headlines and you think everything is going to change right now. And the truth of the matter is everything doesn't change right now. The pace of change is usually a lot slower. Adoption is usually slower than whatever the headline tells you it will be. And so I often find that actually creates an arbitrage opportunity where you can come in while everyone else is thinking the sky is falling, because the sellers feel that too. If you talk to some of these stenographers, these folks that own, businesses that do court reporting and stenography, they think that, this AI thing is gonna destroy their business. And as a buyer, that's an advantage to me. Like if they have that fear, that's going to surely, that's going to surely be relevant when they're thinking about valuation and their desire to sell their business today or soon. So again, I just think it's important, this is why you need to go deeper when you're thinking about your investment thesis, when you're having conversations with sellers. I think it's very, very easy to just follow the herd or just to dismiss some of these things that the headlines would tell you, tread carefully. But sometimes that's really where the opportunity is.
No, it's a really interesting perspective, and I think time will tell. And I'm excited to see
Yeah.
what your next investment is. But we spoke about you being a professor now and teaching ETA. What kind of trends are you seeing in the space,
Yeah.
especially since you're working with so many people who are, I guess, the next generation of searchers, if you will.
Yeah. I mean, listen, some of it's good, some of it's not good, right? Like I think let's talk about the good. The good news is if you want to go out and buy a small business and grow it, so much has changed. Normatively, people wouldn't have understood it 10 years ago. If you wanted to do a self-funded search, and that's changed dramatically. Just the idea of what is entrepreneurship has changed dramatically to mean not just startups, but also this idea of buying and building a small business. Second, there's a lot more architecture out there. There are many more folks like you who are out there educating the community, teaching best practices around how to go out and do a search and buy a small business. I think a lot of folks have jumped in though, and it's incredibly crowded right now. There are a lot of folks who, want to raise a search fund. They want to do a self-funded search. You know, it used to be that these subscale assets, they weren't getting, these sellers weren't getting, 5 offers within the first week and a half. That's always what attracted me to this space is in upmarket private equity, everything's an auction. You go down market, one of the beauties was it used to be you could find proprietary deals, easier. Today it's a lot harder. It's just everyone is cold calling. If you own an HVAC business, you're getting called all the time. And so I think it's going to take a little while for some of the research to catch up. But I think, for would-be searchers, it's important to go in and just recognize that you're not alone. It's starting to become pretty crowded. It's not going to be easy. And so you just need to make sure that you're committed to a path that's going to have some ebbs and flows. And it could easily take you at least 24 months to find that business that you like. I mean, obviously interest rates, have gone up. We were hoping they'd come in. I'm not sure that they're going to come in for a while. It's interesting on the traditional search side. I think the space is going to blow up. I think I'm seeing the convergence of private equity move down market again because there's an opportunity to try to get away from a lot of these auctions at really, really high valuation multiples and try to transact, a little bit more down market. Shore Capital is a great example here in Chicago. They've done something like 1,000 deals with an average enterprise value of about $11 million. To transact at that sort of scale at the subscale of the market, you can only do that if you have really, really good systems and processes in place. So just seeing them do that, it's really, really neat that they're able to do that. But oh, by the way, that also means that they're trying to buy that $10 million deal, that 2 million EBITDA deal that you might be trying to buy as well. And then related to traditional search, I mean, historically, a lot of folks, who wanted to go out and raise a search fund, they would have 10 investors. Each of those investors would contribute 10% or so of the cap table. I think that's going to change a lot. I think what's going to start to happen, and then they work together for 5 to 7 years, find a deal, grow the deal. If you're an investor and you only own 10% of that deal, really, how invested are you? How incentivized are you to really, as a strategic investor, help that searcher go out and find that deal and then grow that company? I think what's going to happen is that there's going to be a bit of a convergence between some of the traditional search and the lower middle market private equity. And it's going to be a really interesting opportunity, I think, for the top traditional searchers. What it means is they're going to come out, they're going to raise some capital. Maybe their cap table looks a little bit different. Maybe a private equity firm like Shore ends up owning a larger percentage of their search and of their deal. But now it gets really interesting. Now, they have a true strategic investor on their cap table who knows how to do deals. And so if that searcher finds a good business and they're a good operator, now they may have access to something akin to permanent capital to go out and do deals. Now they might have access to this proprietary deal engine that the private equity firm already uses. Maybe they have access to actually, after they grow their business, instead of selling it, to actually recap it. And, almost like a continuation fund transaction, continuation vehicle, have one of these closed-ended funds acquire their business, knock out the other investors, and now they continue to work with that private equity firm for 10 years or 12 years and do a bunch of deals. And that relationship and the ultimate financial outcome can end up being much more exciting, much, much larger. And so I'm really excited about, everything that's been happening, in large part because for so many years, traditional search just sort of looked the same. It was relatively static. It didn't change that much. I think it's going to start changing. I think even on the self-funded side, the amount of support, particularly for mid-career searchers, is really starting to develop. You go on searchfunder.com, there's a lot of folks out there that want to throw capital into these deals. I don't think that that's going to change. I think what may change is a lot of that stuff is happening in a somewhat informal way. And it's going to be curious to see how all of this evolves. I imagine what's going to happen is that some of these inputs are going to become a little bit more formal and a little bit more institutionalized. And that's going to end up giving, for instance, that mid-career searcher a much better apparatus to partner with to go out and do a search and buy a business and grow it.
No, I think that makes a lot of sense. And I think you're already starting to see that in the market a little bit. I'm curious with your students, most of them I'm guessing are MBA students, but do you see more of a trend towards self-funded search and
Yeah.
away from traditional?
So it's really interesting today. WashU, where I teach, it's a great business school. It's not a top 5 business school. It's probably a top 15 business school. And so WashU is a pretty good example of what I see happening in the market. If you're at Harvard, a Stanford, an MIT, a University of Chicago, a Kellogg, you have a lot of access to go out and do a traditional search. Um, you have access because for 30 years, that architecture has been built. The teachers that teach the search fund class, maybe they're the investors. Maybe they're affiliated with an investment fund, like a Trilogy or a Pacific Lake. Or there's a very strong history and a very strong architecture to enable a lot of those students to go out and do a traditional search. That's not present really below maybe the top 7 or so schools. And so what I see is once you start to go down the line a little bit from a rankings perspective, now a lot of the students, maybe they can go through an accelerator, but for the most part, they just don't have access to a lot of that sort of that top shelf search fund capital. And so, yes, a lot of the students sort of at, 10, 15, 20, sort of that range from a rankings perspective, a lot more of those students are doing self-funded searches. The good news is, I think for a lot of people, a self-funded search might be the better path for them anyways, right? There's an opportunity if you do a self-funded search, you have all of these advantages with the SBA 7A program, 90% loan to value on the loan, a 10-year maturity date. You can own a lot more of your cap table than the typical 25% or so if you do a traditional search. So again, that's sort of what I'm seeing. I think what's sort of interesting is, folks are getting a lot smarter and they're starting to really ask themselves the question and ask a lot of people in our space the question, should I be going down the traditional path? Should I go to an accelerator? They're interning at accelerators to understand what that means and what that looks like. They're having conversations with local or national SBA lenders, and they're doing some really good work, typically around their second year of business school, to try to suss out first if I want to do this, if I have conviction around doing this instead of doing anything else that I could do when I graduate. And if the answer is yes, then it's an execution question. Do I want to go out and do a self-funded search? Do I have access to the 10% or the capital that I would need to do that? Am I a self-starter? Can I figure out how to successfully implement that self-funded search? Or, do I want my hand held a little bit more? Do I want to go down that traditional path? I think what you'll often find is I've seen some data from accelerators where, 88 to 95% of their searchers close on a deal. It's a pretty high percentage. Obviously, the Stanford Search Fund study says about 2 in 3 on average will close on their deal. I don't know what the stats are for self-funded, but I think it's lower. I think it's a harder path. You don't have that hand-holding. You've got to sort of figure it out a little bit more on your own.
I wonder if you think, on the traditional search side, that stat is gonna decline with,
I think it is
more
declining.
with just
I
the
think it's lagged,
competition.
and I don't think it's shown up yet. We'll have to see the next Stanford Search Fund study. Um, I do think it probably already has gone down, and maybe just hasn't sort of shown up yet in the data set. But there are just some macro reasons why, why it probably, will go down or could go down or should go down. But I don't know. Anecdotally, it just sort of feels like, and this is true in any type of search that you do, I think it's probably a little bit harder versus sort of what folks may have heard a year or 2 or 3 years ago. It just feels to me that as interest rates have gone up, as more folks have sort of jumped into the space, it just feels to me like it's just a little bit harder than it probably was a few years ago.
Yeah, I think it's just with a lot more private equity competition too. I think, the traditional searchers are looking at the same size deals still.
It's so true. So I had a call. I also love pest control, right? And I think pest control is probably one of the best the best industries, and like just good subscription revenue. My wife always tells me if we have a recession and you try to cut our expenses down, you better not. The last thing that you're ever going to cancel is sort of our pest service. It is just totally mission critical. But I spoke with a public company in that space, one of the big names, a couple of years ago, and he said he runs M&A for them. In pest control, like a lot of these home services businesses, it's all about route density. You don't want your technician in the truck driving 45 minutes or an hour. That just kills your financial model. So it's all about being able to move point to point as efficiently as you can. And he was telling me, he said, listen, we do a lot of M&A. Just a handful of years ago, we wouldn't have touched a deal where the enterprise value was less than like, I think it was $5 million. Like it just wouldn't have been worth it. We're a really big company. We're a public company. He said recently, I've done a couple of deals at $1 million if it gives me better route density. And it sort of shook me because I was thinking like, man, I'm like out there at the time trying to find a pest control business, and this public company may be calling on these same sellers that I am. Like it just feels so unfair. And so I think you're exactly right. I think when you look at them, when you see that Shore did 1,000 deals at an average EV of 11 or $12 million, when you just hear some of these anecdotes, it surely must mean that it's just a really competitive moment in time, and hard for for sort of the self-funded searcher or even the traditional searcher to get through the noise and convince the seller that he or she's the right one for this asset.
I'm curious, I know we're well over on time, but given the challenges and given how much more competitive it has gotten in this space, I'm curious, why are you still bullish about it and why are you still
Yeah,
continue to be invested in the SMB space?
yeah. So I think that I try to come into this with a really long-term horizon. And so I think that if investors were to tell me, listen, we'll give you a bunch of money, invest in the space, you need to get a deal done in a year, it needs to be a good deal, I wouldn't take that capital. I think that's a really, really hard undertaking. But I think if, I continue to believe that there is value at the subscale end of the market. Valuations, you can still buy a business for 3 or 4 times cash flow that can be really robust, resilient revenue. There can still be some significant opportunity to grow that business. So I'm still attracted to this end of the market, sort of full stop. I think what you need to do is you need to come in and think about the execution in a different way. And so some of the things that we've been exploring to try to gain a competitive advantage, one, just have a longer term horizon. The second is to maybe come at this with a different sequence. So when we started down this path, we were really focused, like everyone else, on $1 to $1.5 million EBITDA SDE, as sort of our target for our platform acquisition. We really struggled, particularly in these frothy areas, IT, MSP, HVAC, to find that business for all the reasons that you mentioned. And so one of the things that we've been thinking about is maybe even going further down market. A lot of people would say, don't buy that business that's only doing $500,000 of SDE. You're only buying a job. Maybe there's a lot of key man risk because at that sort of threshold, the existing owner might be doing all the work. It'll probably have more warts. I mean, all of these statements are true. Don't get me wrong. But I think that, again, much like how the pace of technology, I think that maybe they're a little bit overblown. So one of the things that we've thought about doing, or I've thought about doing, this is something that Shore does, but sort of in a different way, is maybe sort of over-investing in that first acquisition. And by that, I mean, maybe we buy a business that's just doing $500,000 of SD or even maybe even a little bit less, and get one of our operators in the seat. Now, what that may mean is that I actually have to supplement the working capital needs, the cash flow needs of that business for the first 12 months or the first 18 months as we work to stabilize and grow that business. But as I've thought about it, if we want to do bolt-on acquisitions, and if I believe that there is a meaningful opportunity for multiple expansion, maybe that incremental cash investment at closing and being able to just execute more quickly in an industry that we really love, maybe in a geographic area that we really love, maybe it's worth it. Maybe taking a longer term horizon and accelerating the process of getting the operator in the seat to actually start to do the work. Maybe there's some logic to that. So I just use that as one example. We've thought about a bunch of different ways to change the sequencing of the traditional playbook. We've looked at a bunch of different ways to think about capital a little bit differently, to think about target companies a little bit differently. We don't have the answer. We don't have the right recipe, but I think it is important when you're seeing the market probably the same way that you are today. I do think it's important to sort of step back and say, how can I create strategic advantages here against the market? Because if I just play the same game that everyone else is playing, particularly when the other players are private equity and public companies, it's going to be really, really hard to be successful.
I think you're right, and I think I think you'll see a lot less competition in that 500K SDE
Yes.
mark, or even less, and you just have much stronger advantage there. And I mean, not to mention, I think just the volume increase, right? Like, I
Yeah.
think once you hit the 1.5 million EBITDA business, it's just there's not as much volume, and that's the reality. So,
Yeah. I agree. I agree.
well, Brian, this has been great. Any sort of final words of wisdom for the folks listening to this, who maybe are first-time buyers, especially?
Yeah. I mean, listen, I think it's just important to really go into this with an honest view. As you know, I think we're doing a better job of this in the industry, but historically, folks would listen to podcasts and it would often be all of these home run outcomes. And those stories are important, no doubt, and they're real, no doubt. But I think that to your point a short time ago, this is a competitive space and it's not easy. I mean, you and I both work very, very, very hard and we're constantly learning and it's trial and error. And I think what's really important is that folks who are interested in going out and buying a small business, I think it's important that they have the right conversations early on, including with folks who maybe struggled to find that acquisition or maybe became operators and realized that they weren't as good as they thought that they would be. I just think it's important to at least be able to see a full 360-degree view about what they're getting into. Because I think if they're not intentional about that, it's very, very easy, to read one of these books, to listen to a handful of the podcasts and feel like, listen, there could be a real pot of gold at the end of this. There could be a real pot of gold at the end of this, but there's going to be a lot of lonely nights and days along the way. And you just really have to have a stomach for the ups and the downs, because hopefully there'll be a lot of ups, but there's definitely going to be some downs too.
I couldn't agree more. I think, so much of it is setting the right expectations. And I think a lot of folks don't come in with the right expectations. All the time I get folks who are like, I'm ready to buy a business. I'm eager to close in 3 months.
Yeah.
And
I'll close on anything. Right. All
I
right.
have no criteria. I can do anything.
Yeah. And maybe this is the conservatism in me coming out. I love the bias toward action and the spirit, but there really is a balance. And I know you and I, we've talked about that before. I know we both agree on that.
Absolutely. Well, Brian, actually, final question. If people after listening to this want to reach out to you, where can they find you? What's the best way to reach out?
Yeah, so I'm on LinkedIn, pretty active on LinkedIn. Last name is WOL, F as in Frankie. First name Brian with an I. You can also go to fundedventures.com, and love hearing from folks. So one of the things that I love about this space is, for the most part, everyone roots for each other. And so it's great to spend time with people who are passionate about this space and would love to hear from folks. So thanks very much.
Well, Brian, thank you again. Really enjoyed this conversation today. I certainly learned a lot, and I'm eager to hear where this journey takes you next.
Well, thank you. That goes for you too. I know we'll be talking again soon. Thank you very much.